Good afternoon, everyone. Thanks for attending the mandatory training on Bank Secrecy Act, anti-money laundering policy, and suspicious activity reports. We're just going to go through a little background here. The Bank Secrecy Act requires all financial institutions, including residential mortgage lenders and originators, to monitor customer behavior, file reports on transactions that meet certain dollar amounts, and maintain records of certain transactions. And the purpose of the Bank Secrecy Act is really, for our purposes, to uncover criminal activities such as mortgage fraud. That's what our focus is mainly going to be. It also includes money laundering and tax fraud, but mortgage fraud is our main focus. USA Patriot Act, it was signed into law in response to the events that occurred on September 11, 2001. It provides the government with additional tools to prevent, detect, and prosecute money laundering and the financing of terrorism. And it includes amending the BSA to require all financial institutions to implement anti-money laundering programs. That's the reason we have this policy in place now as a non-depository mortgage loan institution. It also directs the Treasury to prescribe regulations requiring financial institutions to identify customers in connection with the opening of accounts. That's really the focus here. It's going to be the use of customer identification programs when these borrowers open accounts through us, and that account's going to be the mortgage loan. And various sections of the USA Patriot Act address suspicious activity reporting requirements. Financial institutions is broadly defined to include, among other entities, banks and other depository institutions such as credit unions, money service businesses, securities, broker-dealers, insurance companies, sellers of vehicles, loan and finance companies, which is where we're going to fall under, and it's also broad enough to include persons involved in real estate closings and settlements. FinCEN is the Financial Crimes Enforcement Network. It's a bureau of the Treasury Department, and the Treasury delegated FinCEN the authority to implement, administer, and enforce compliance with the Bank Secrecy Act. And one of the effects from time is a focus shift from the funding of terrorism and to a real focus on occurrence of mortgage fraud. Customer identification program, although FinCEN did not expressly implement a customer identification program for non-bank mortgage lenders and originators, the requirements are pushed down from the bank lenders and investors, and the Fair and Accurate Credit Transaction Act, otherwise known as FACTA, amended the Fair Credit Reporting Act to add identity theft programs, also known as the red flag rule. We'll just go through some key definitions. Residential mortgage lender is the person to whom the debt arising from a residential mortgage loan is initially payable on the face of the evidence of indebtedness. And if there is no evidence of indebtedness, the person to whom the loan is payable by agreement or to whom the obligation is initially assigned at or immediately after settlement. That's just put in there to also include handshake agreements. And there is an exclusion for an individual who finances the sale of his or her own dwelling or real property. Definitions of an originator. For the originators on the call, you might notice that the definition under the BSA differs slightly from the SAFE Act. A residential mortgage originator is a person who accepts a residential mortgage loan application or offers or negotiates terms of residential mortgage loan. And the difference between this and the SAFE Act is the word accepts versus the word takes. And just a question to throw out there is how many different definitions of originator is our government going to adopt?
I'm hoping 14.
14. Good round number. Definitions of a loan. A residential mortgage loan is a loan that is secured by a mortgage, deed of trust, or other equivalent consensual security interest on a residential structure that contains 1 to 4 units, including if used as a residence, an individual condominium unit, a co-op unit, mobile home, or trailer. And the definition also includes residential real estate upon which such a structure is constructed or intended to be constructed. And now we'll just go through a quick run through of the AML program and suspicious activity report requirements. Any money laundering program requirements, if you take a look at the picture, you'll see that it has 4 columns supporting the top structure. And any compliant AML program is going to have 4 pillars to remain compliant. And these are the development of written internal policies, procedures, and controls, a designation of an AML compliance officer responsible for ensuring that the program is implemented effectively, including monitoring of compliance by companies, agents, and brokers. AML program is updated as necessary, and appropriate persons are educated and trained. And pretty much everyone within this company is going to fall under appropriate person. It's going to need that education and training. Other requirements are going to be ongoing periodic training of appropriate employees about the company's AML policies and procedures, and that's going to be done on an annual basis, and periodic independent testing of the AML program. When must a suspicious activity report be filed? Well, it must be filed on any known or suspected federal violation of law, and a suspicious activity requires reporting if it involves at least $5,000 in the aggregate and the institution knows or suspects that the funds are derived from illegal activities, funds are part of a plan to violate or evade any federal law or regulation, or the transaction is designed to evade other reporting requirements, or the transaction is not the sort in which the particular customer would normally be expected to engage, and the institution knows of no reasonable explanation for the transaction. In other words, it doesn't really make sense. But for all practical matters, SARs really mean something ain't right. Basically, it's going to be a smell test. If it fails a smell test, you're going to need to elevate it up the chain. You're looking for a decision based on all the facts and circumstances relating to the transaction and customer of the company in question, and different fact patterns will require different judgments. So there's no blanket rule on this set of events. This is going to occur. You have to take a look at the totality of the circumstances. The means of commerce and the techniques of money laundering and mortgage fraud are continually evolving, and there's no way to provide an exhaustive list of suspicious transactions. If we even attempted it, it would be thousands of pages long, because any little difference could be a different outcome. First question to ask is whether the activity is reasonable for the customer, or whether something just isn't right. If not, then that rises to the level of suspicious activity. Like I mentioned earlier, the smell test, if it smells funny, it might be. You need to elevate it up the chain. And whether the activity ultimately is criminal, fraudulent, or related to terrorist activity is up to the government to determine. And that's really just saying that it's not going to be up to any ICE or employee to ultimately determine if a crime occurred. It's going to be up to the government agencies. We don't make that final judgment. look at some type of reportable activity for suspicious activity reports. First one's going to be money laundering. It is not taking money, $20 bills, throwing it in a washing machine and laying it out on a clothesline. It's really the process of conducting financial transactions and or taking the proceeds from an illegal activity and making them appear to be from a legal source, or hiding them or placing them beyond the reach of the government, or utilizing a series of transactions, transferring the proceeds to a Paying Secrecy Act country, and later returning those funds to their original source. Well, in other words, bad guy is really trying to disguise the source of the funds, change the form of the funds, move the funds to a place where they are less likely to attract attention, or place the funds back into the mainstream. Reportable activity. Continuing on is we're going to talk about some red flags for money laundering or other criminal activity. And before I go on, just because something is a red flag doesn't mean that it is ultimately going to be determined that it's suspicious activity. It's not going to automatically kill the file. It's just something out there that tells you to take a closer look at what's really going on with the transaction. And first source of information you'll always want to use is going to be talking to the consumer for an explanation, because a lot of times a good explanation that makes sense can clear the red flag. Not always, but it's definitely your first step. But going on with that, some of the red flags that we want to look out for as far as money laundering is concerned is the customer exhibits unusual concern about ICER's compliance with government reporting requirements and ICER's AML policies, and especially when it's concerning his or her identity or type of business, or the customer is reluctant or refuses to reveal any information concerning business activities, or the customer furnishes unusual or suspicious identification or documents. Another red flag to look for is a fraud or activity alert that is included with a consumer report obtained with respect to the consumer. A consumer reporting agency provides a notice of credit freeze in response to a request for a credit report. Couple three red flags here. A consumer reporting agency provides a notice of address discrepancy. The customer wishes to engage in a transaction that appears to lack sense. Basically, you want to make sure that the transaction ultimately makes sense. An occupancy issue comes to mind. The information provided by the customer that identifies a legitimate source for funds is false, misleading, or substantially incorrect. Or upon request, the customer refuses to identify or fails to indicate any legitimate source for his or her funds and other assets. More red flags for money laundering. The customer or a person publicly associated with the customer has a questionable background or is the subject of news reports indicating possible criminal, civil, or regulatory violations. Customer exhibits a lack of concern regarding transaction costs, or the customer has difficulty describing the nature of his or her business. That's a really big red flag, because if they're in charge of a specific business, especially your smaller borrowers with small businesses on Schedule Cs, they really should know what they're doing in regards to that business. Another big red flag is the customer is flat out asking for an exemption from our anti-money laundering policies, or the customer requests that a transaction be processed to avoid our normal documentation requirements. Other red flags in regards to money laundering are going to be the application is linked to locations of concern or initiated by a person whose name appears on the OFAC list. Our data verified drive reports are going to be very helpful for that. In particular, customers' file tax returns differ from those provided to iServe. No record exists of past or present employment listed on loan application. And customer provides unusual or suspicious identification documents. Reportable activity as it relates to mortgage fraud. This is where the main focus of FinCEN is in regards to residential mortgage loan originators. It's going to include customer appears to be acting as an agent for an undisclosed principal, but declines or is reluctant without legitimate reasons to provide information, or is otherwise evasive regarding that person or entity, commonly known as a straw buyer. Title to the subject property is held by virtue of an unrecorded deed. With that, we have an issue with clouded title just to begin with. The property securing the loan was recently paid off. Reason this is on here is it's not normal for someone to pay off a loan completely and want to go and take out a loan against that property. It doesn't normally make sense. So what we have to check for is a fraudulent lien release, and we could just check with the previous lien holder to make sure they were actually paid. Another example is proposed sale is occurring within a year of obtaining title. Let me just reiterate again that red flags don't mean automatically kill the file. We know that there are professional property flippers and agencies that do this, so these are just questions to ask. Three more mortgage fraud red flags. The purchase contract provides for a large allowance, which may signal that the allowance is a method for the seller to funnel down payment funds to the buyer. If the concessions don't make sense, you really need to look into that, ask some questions. Brokers or other agents are receiving excessive commissions. That could signal a possible payoff to look the other way. The sales price exceeds fair market value. With that, you just really want to ask the borrower why they want to proceed with paying more for a property than what the market value. There's oftentimes legitimate reasons for that. Party requests that the loan be used to pay debts not secured by the property or required by the lender, looking to see if they're trying to pay off a shell company. The file contains more than one contract with significant differences in price, or the buyer's check indicates another to be the provider of funds and no gift letter is presented. The reason we're really looking into this is you can see here that the number of suspicious activity reports in relation to mortgage fraud have increased substantially. 2010, there were 70,472 filed, and 2011, there were 92,028, and this indicates a 31% increase. This is even before non-depository lending institutions have to file. So now that they now are subject to the BSA rules and have to file suspicious activity reports, who knows how large these numbers are going to increase to for 2012 and 2013. Most common types of mortgage loan fraud that were found for the years 2004 to 2009 was use of straw buyers, sellers remaining on the property by renting it back from scammers, equity skimming or property theft, misrepresentations in income, employment, or occupancy, false statements, and advance fee scams. So you want to be careful, especially for the misrepresentations, because that could be a very good indicator of possible fraud. How to file. don't really have to be concerned with how to actually file a suspicious activity report. This is just an example of seeing what the beginning of one looks like. They ask for a lot of information. They're basically going to be done electronically. Reporting deadlines. Suspicious activity report must be filed no later than 30 days after the date ISER becomes aware of a suspicious transaction. And if no suspect is identified on the date of the initial detection, it must file no more than 60 days after the date of initial detection. And the date ISER becomes aware is the date that anyone in the company becomes aware of it. And as you can see with 30-day timeline, we really need to move quickly once we're aware of that. Just a quick note on retention of records. Any documentation included or relating to a possible suspicious activity report we're going to keep for 5 years. And that's going to be whether or not we decide to file the suspicious activity report once it gets to that level that a decision really needs to be made. BSA requires strict confidentiality, and a suspicious activity report and information that would reveal the existence of a SAR must be kept confidential. It can only be disclosed to FinCEN, federal, state, or local law enforcement, federal regulatory authority that examines the company for compliance with the BSA, state regulatory authority administering a state law that requires the company to comply with the BSA, and ISER will not notify any person involved in the transaction that the transaction has been reported, except as permitted by the BSA regulations. But in general, disclosure of the fact that a SAR filing is contemplated or has been made is a violation of federal law. So on that note, it's not going to be disclosed to anyone is the main point. But along those lines, even though we cannot disclose that someone is being investigated for the possible filing of an SAR, it doesn't mean we cannot ask questions from that borrower for our investigation. There is a safe harbor, and that's no company or its officers, directors, employees, and agents may be held liable to any person or entity under any federal statute or regulation or under the Constitution, law, or regulation of any state or political subdivision for disclosing suspicious activity or for failing to notify the person or entity who is the subject of or named in the report. Basically telling you that even if it is determined that it's not suspicious activity and we go ahead and file the report, we're not going to be held liable. How we maintain compliance with the BSA, well, we need to take a look at what all employees really need to be doing under the policy. And the first thing we need to do is understand and comply with the letter and spirit of the AML laws, AML policy and procedures. We need you to avoid willful blindness. If something is a red flag, do not just look the other way. And most importantly, never disclose to customers that a suspicious activity report has been filed or even been contemplated. What is your role in the Anti-Money Laundering Policy and Bank Secrecy Act? We need to be alert to unusual or suspicious activity. Need to analyze and document any unusual or suspicious activity. Need you to obtain missing information to avoid duplication of effort. The quicker we can find the information out, the quicker we could try to clear anything. We'll skip the next one and go on to obtain required information. You're also going to be subjected to annual training on the policy. And the reason I thing, let's get that one, because ask why. It's really your first line of defense for anything that might be a red flag. Just ask why. Borrower could probably provide some good information for you. How do we have maintained due diligence with policy? Asking multiple questions. Ask questions such as, has the information on the application been verified? Have any large sums been deposited into the accounts in the last 6 months or year over and above what would be normal for the borrower? Did you compare credit report info with what you see on bank statements or tax returns? Have you reviewed the tax returns and or financial statements to determine if this transaction is possible based upon past history? And do you know how to review a tax return and what to really look for? Three more. Are there any changes since the filing of the last return that makes this transaction a game changer, such as winning the lottery or obtaining an inheritance? Is there any indication that there are guarantors, beneficial owners, or silent partners for the property being purchased? And if so, have we identified them and the source of any cash as down payment? Is there a verifiable source of income for the person or persons applying for the loan? Is there a record of past or present employment that can be verified? And the procedure on what to do when you actually have red flags is, if a red flag is detected, immediately contact your head underwriter. And if the head underwriter determines that suspicious activity may exist, he or she will immediately contact the compliance officer and director of operations to see whether further investigation should be undertaken. We'll need everyone to report any unusual or suspicious activity to the head underwriter. And with this procedure, we want everyone to know that no employee will be disciplined for properly reporting suspicious activity. A couple scary items to look at. There are civil penalties for noncompliance with the BSA, and failure to comply with record-keeping requirements are up to $1,000 per violation. Failure to comply with a reporting requirement not to exceed the greater of the amount involved in the transaction, not to exceed $100,000 or $25,000. Continued noncompliance could result in the issuance of cease and desist orders. And another possible civil penalty is the forfeiture of assets. There's also criminal penalties associated with noncompliance. A person willfully violating the BSA shall be fined not more than $250,000 or imprisoned for not more than 5 years, or both. A person willfully violating the BSA while violating another law of the United States or as part of a pattern of any illegal activity involving more than $100,000 in a 12-month period shall be fined not more than $500,000, imprisoned for not more than 10 years, or both. And a separate violation occurs for each day the violation continues, and at each office, branch, or place of business at which a violation occurs or continues. Business or business. Different. Sorry. And although there are civil and criminal penalties, I have to let you know that iServe is committed to a comprehensive AML program, and willful or grossly negligent violation of iServe's AML policy may be ground for discipline. And that's up to and including termination. and could also expose the employee to civil or criminal penalties, including imprisonment. We need you to understand that it's not necessarily ICER, the company, that will suffer penalties for noncompliance, but also individual employees that are in violation. So we ask you to do not compromise your position at ICER by ignoring AML regulations.
Okay, questions? Guys, thanks for hanging in there. We're going to open it up to questions at this point. If you would be so kind, if you do have a question, to type it in the chat or question box over on your GoToWebinar menu there. I'm going to go ahead and stop the recording.